My name is Ryan O'Kane with ARBOR Financial Group. I've been in the mortgage industry for 15 years. The number one question I get from customers is, what are my closing costs? So I made this video to hopefully help explain that to you, your friends, and your family. First of all, there's no such thing as a no closing costs or a no fee loan. Every loan has closing costs, every loan has a profit margin, every loan has some type of fees. The question is, how much of that are you paying for? For example, on a $400,000 loan, most banks and brokers will make a 1% profit margin, so in this case $4,000. On that same loan, assuming it's a refinance, there's a certain amount of fixed closing costs that go along with that to pay third parties. For example, appraisers, credit report, escrow, and title. That amount typically ranges between $2,500 to $3,000 depending on the type and size of your loan. So if we carry that to the $400,000 example, you have $4,000 in profit margin and you have $3,000 in fixed closing costs. So on that particular loan, the total cost is $7,000. Now, when you choose your rate for your mortgage, there's what's called a par rate, which is the rate that the bank and the broker don't give you any credit for your interest rate chosen. It's called the par rate. So let's, for example, say that today's par rate is 4%. Now, it may or may not be, and rates change every day, but for this example, let's say the par rate is 4%. If that were the case, you would get your $400,000 loan, and when you went to close your loan, you would pay the full $7,000 in closing costs out of pocket. Now, the higher the interest rates are on loans, the more valuable they are to banks and to secondary market folks that buy them. So if you increase your rate from the par rate, the bank or the broker will in turn give you a credit towards your closing cost since it's a more valuable loan now. So for example, if you were to choose an interest rate of 4.25 as opposed to 4%, well, your closing cost credit would be $3,000. So at 4.25, your total out of pocket would now be $4,000 as opposed to the 7. So as you can see, the higher in rate you go, the more credit you get towards your closing cost. If we take that example further to, let's say, a rate of 4.5%, your closing cost credit would actually equal the full $7,000. It would pay for all the profit margin to the bank and all the closing costs to the third parties. That example at 4.5% is what's commonly referred to as a no-cost loan. And the key there is to make note that while it's a no-cost loan, you're still paying for the cost because you're taking a higher rate. And so when you're making your decision on what rate to choose, it's important to work a break-even model out between that par rate and your no-cost rate to make sure that you're choosing the right closing cost option that's going to meet your plan for the property you're buying. Typically, if you're going to be in that property for longer than 7 years, it would make sense to actually pay and buy down your interest rate. I hope you found this video informational, and feel free to give me a call if you have any questions on what was discussed here. Thanks so much for listening.